Welcome to Markets in Minutes, the macro, micro, economic, and financial commentary companion podcast. I am your host from the Macro Micro Research Team, and this is our weekly deep dive into the forces shaping global markets and the economy. This week, we're examining three compelling developments that paint a picture of an economy firing on multiple cylinders, but with some fascinating contradictions beneath the surface. First, we'll explore how Q2 bank earnings reveal a tale of two economies, with investment banking booming while consumer lending stagnates. Then, we'll analyze Bitcoin's remarkable surge past $120,000, driven by both regulatory clarity and global liquidity expansion. Finally, we'll dig into the curious case of June's retail surge and inflation acceleration, questioning whether we're seeing real demand growth or simply the effects of rising prices. Let's start with the banking sector, which delivered some of the most telling insights about our current economic moment. The second quarter earnings from America's largest banks tell a story that is both reassuring and revealing about the underlying currents in our economy. What we're observing is essentially a two-track system where corporate America is thriving while consumers are pulling back from major financial commitments. JP Morgan Chase led the pack with $44.9 billion in revenue, comfortably beating estimates of $43.9 billion. This wasn't just a numbers game, it reflected genuine strength in investment banking activities. Goldman Sachs followed suit with $14.58 billion in revenue, well above the $13.47 billion analysts expected. The driving force here was clear. Trading and advisory fees surged as corporate clients engaged in deal-making activity. Our analysis indicates this corporate vigor stems largely from policy tailwinds that have created a more favorable environment for business transactions. Goldman's investment banking fees alone jumped 26% to $2.19 billion, nearly $300 million above estimates. This reflects something deeper than cyclical recovery. It suggests businesses are actively repositioning for what they perceive as a more business-friendly regulatory landscape. But here is where the story gets interesting. While investment banking flourished, the consumer side of banking faced headwinds. Mortgage lending, in particular, struggled under the weight of elevated interest rates. 30-year mortgage rates hovering between 6.75% and 6.9% have effectively priced out many potential homebuyers. Wells Fargo specifically cited muted mortgage business as a drag on revenue, while Bank of America faced similar pressures in consumer lending growth. The data reveals a fascinating divergence in net interest income across institutions. JP Morgan managed to edge up 2% to $23.3 billion, but Wells Fargo dropped to $11.9 billion, pressured by rising deposit costs and stagnant loan origination. This isn't a story about credit quality deteriorating. Rather, it is about consumers making rational decisions in a high-rate environment. What is particularly noteworthy is how stable credit metrics remain across the sector. Bank of America's data shows consumer credit holding steady, with net charge-offs flat at $1.5 billion and delinquencies actually declining by 24 basis points from the first quarter. Corporate credit quality was equally robust, with commercial charge-offs up modestly but non-performing loans declining. This credit stability underpins our view that we're not dealing with a stressed financial system, but rather one where different segments are responding rationally to current economic conditions. The American Bankers Association's Q2 Credit Conditions Index did decline to 32.1, down 9.1 points. But this reflects forward-looking concerns about tariff uncertainties rather than current credit stress. The broader earnings picture reinforces this sector strength. According to FactSet, 83% of S&P 500 companies that have reported so far beat earnings expectations, with financials leading the way at an 11.2% earnings surprise. 91% of financial companies reported better than expected earnings per S-Hair, setting a strong foundation as we move into earnings reports from the so-called Magnificent Seven technology companies. This banking performance tells us something crucial about the current economic moment. Corporate confidence remains high, Deal activity is robust and credit quality is solid. However, consumers are being more selective about taking on debt, particularly for major purchases like homes. This isn't necessarily a warning sign. It is more likely a sign of financial prudence in an environment where borrowing costs remain elevated. Turning to cryptocurrency markets. Bitcoin's surge past $120,000 represents far more than speculative fervor. It reflects a convergence of fundamental factors that have transformed the cryptocurrency from a niche asset into legitimate institutional infrastructure. The most significant driver has been the rebound in global M2 money supply growth from major central banks. This expansion in traditional currency supply has reignited Bitcoin's appeal as a hedge against fiat currency debasement. Unlike traditional currencies, which can be printed without limit, Bitcoin's supply is mathematically constrained, making it increasingly attractive as central banks worldwide continue expansionary policies. Institutional adoption has reached unprecedented levels. US Bitcoin ETFs recorded their fifth largest net inflow since debut with $2.7 billion just last week, bringing total assets under management to $151 billion across 12 ETFs. This isn't retail speculation. It is institutional capital allocation on a massive scale. The derivatives markets tell an equally compelling story. Open interest in Bitcoin futures hit a record high of $86.3 billion, while over $1 billion in short positions were liquidated as traders positioned for continued liquidity-driven gains. This level of institutional engagement in Bitcoin derivatives markets was virtually unthinkable just a few years ago. But perhaps the most transformative development has been regulatory clarity emerging from Washington. The House's Crypto Week featured key legislation, including the Genius Act, which establishes a federal stablecoin framework requiring 100% US dollar-backed reserves. This isn't just regulatory housekeeping, it is the creation of legitimate financial infrastructure. The Genius Act mandates that stablecoin reserves comprise exclusively US dollars, bank deposits, and treasury securities with 93-day maximum maturity. This differentiates American stablecoins from global competitors and channels stablecoin growth into dollar-denominated assets, effectively making cryptocurrency infrastructure a tool of dollar dominance, rather than a threat to it. This regulatory framework transforms what was once speculative crypto infrastructure into legitimate financial plumbing. Traditional financial institutions can now issue stablecoins while meeting stringent reserve requirements. With the stablecoin market projected to reach $2 trillion by 2028, this creates substantial new pathways for institutional crypto adoption. However, our analysis suggests caution is warranted as Bitcoin approaches a $4 trillion market capitalization. Historical sentiment indicators are flashing warning signs about potential overheating. The MVRV Z-score Fear and Greed Index and Nupal metrics have historically provided early warning signals when speculation becomes excessive. Sharp rises in the MVRVZ score often signal overheated markets, while both the Fear and Greed Index and MVRVZ score approaching the 80 level historically indicate dangerous speculation. Though exact thresholds vary across cycles, these indicators serve as reliable references for gauging short-term sentiment and timing potential market corrections. What we're witnessing is Bitcoin's evolution from speculative asset to institutional infrastructure, supported by both fundamental liquidity conditions and regulatory legitimacy. However, the rapid ascent to these price levels warrants careful monitoring of sentiment indicators to assess whether current conditions represent sustainable growth or speculative excess that may require consolidation. The convergence of rebounding global liquidity, regulatory clarity, and institutional adoption creates a compelling fundamental backdrop for Bitcoin. Yet, as with any asset experiencing such rapid appreciation, vigilance regarding overheating indicators remains essential for assessing short-term market dynamics. Our third major focus examines the apparent strength in June's economic data, but the underlying dynamics suggest a more nuanced story. It presents a puzzle that goes to the heart of current consumer dynamics. On the surface, the numbers look robust. Retail sales surged 0.6% month over month, substantially beating forecasts and driving year-over-year growth to 3.9%. But our analysis suggests this strength may be more about prices than volumes. The inflation picture shows clear acceleration. CPI rose 2.67% year-over-year versus 2.38% previously, while core CPI increased to 2.91% year-over-year from 2.77%. The month-over-month core reading of 0.23% came in slightly below the 0.3% market expectation, but the overall trend is unmistakably upward. What is particularly telling is the composition of this inflation acceleration. Core goods inflation turned positive at 0.2% month over month, driven by price increases in goods heavily impacted by tariffs. We observed specific increases in household furnishings, apparel, and recreational products, categories that align closely with items subject to recent trade policy changes. Household furnishings rose 1% from 0.3% previously. Apparel increased 0.4% from negative 0.4%, and recreation commodities jumped 1.1% from 0.3%. This pattern strongly suggests tariff pass-through effects are beginning to materialize in consumer prices. However, vehicle prices provided crucial offsetting disinflationary pressure. New cars declined 0.34% month over month, while used cars fell 0.67%. Without this automotive deflation, the tariff impact on goods prices would have been significantly more pronounced across the overall index. Energy also contributed to headline CPI, with a 0.95% month-over-month increase due to oil prices briefly surging above $75 following the Israel-Iran conflict in mid-June. This geopolitical premium has since dissipated, with oil falling below $70, suggesting this energy contribution was temporary. The retail sales story becomes more complex when we examine it alongside these price movements. The synchronization between tariff-affected goods price increases and corresponding retail sales improvements indicates we may be seeing nominal growth rather than volume expansion. Building materials rose 0.9% month over month as prices accelerated, and furniture sales improved alongside their price increases. This pattern suggests consumers are paying higher prices for similar quantities rather than increasing actual purchase volumes. When we examine the historical retail sales index, we see nominal retail sales continuing to climb, while inflation-adjusted retail sales have essentially plateaued since 2021. This confirms that recent retail sales strength primarily reflects price effects rather than underlying demand growth. Services inflation showed more encouraging divergent trends. Rent continued to decelerate to 0.18% month over month from 0.25%, with year-over-year rent inflation moderating to 3.8% from 3.9%. This rent moderation remains the dominant disinflationary force in services, keeping core services inflation stable at 3.6% year-over-year despite pressures in other categories. Other services rebounded to 0.38% month over month, driven by transportation and healthcare costs. However, the continued rent disinflation provides crucial anchoring for overall services inflation, preventing broader acceleration despite pressures elsewhere. Market reactions suggest confidence that these price pressures represent manageable, one-time adjustments rather than persistent inflation. The Federal Reserve maintains expectations for 2 rate cuts this year, starting in September. Post-data declines in the dollar and 10-year yields indicate investor belief that tariff impacts remain controllable. The key validation will come from upcoming real PCE data, which will definitively determine whether June's retail sales strength reflects genuine consumption momentum or primarily inflation-driven nominal effects. This distinction is crucial for assessing whether consumer spending power remains intact or if households are experiencing real purchasing power erosion. Our monitoring framework includes continuous tracking of oil futures curves, daily retail pricing, and alternative inflation measures to provide early warning signals of whether tariff impacts remain contained or begin spreading more broadly across the economy. These real-time indicators complement traditional monthly data by offering more immediate feedback on evolving price dynamics and consumer behavior patterns. Looking ahead, several critical data releases and earnings reports will provide additional clarity on the themes we've discussed today. Tesla's Q2 earnings on the 23rd of July will be particularly important for understanding how tariff policies are affecting the EV sector. Investors will focus on Tesla's 2025 delivery guidance amid the looming expiration of EV tax credits in September. Updates on rare earth magnet and LFP battery import policies will be critical for assessing impacts on Tesla's robotics and energy divisions. Alphabet's Q2 earnings, also on the 23rd of July, will provide insights into how trade policy changes are affecting digital advertising markets. Attention will center on potential advertising revenue impacts from the cancellation of the de minimis rule affecting Asia-Pacific retailers. Growth in Google Cloud's AI business and server related capital expenditure will also be key metrics to watch. From a monetary policy perspective, the Eurozone interest rate decision on the 24th of July is expected to keep rates at 2.15% following June's 25 basis point cut. With HICP inflation at 2%, the easing cycle may pause, though markets anticipate 1 to 2 more cuts in 2025 contingent on inflation trends. The Eurozone manufacturing PMI on the 24th of July is forecast to edge up to 49.8 from 49.5, reflecting modest recovery in European manufacturing. Easing uncertainty from US-EU tariff negotiations supports cautious optimism for business activity, though the reading remains below the 50 threshold indicating expansion. This week's analysis reveals an economy operating on multiple tracks simultaneously. Corporate America is thriving in an environment of regulatory clarity and policy support, driving strong investment banking results and deal activity. Meanwhile, consumers are demonstrating financial prudence, pulling back from major borrowing commitments in response to elevated interest rates, while still maintaining spending, albeit at higher prices. Bitcoin's surge past $120,000 exemplifies how regulatory clarity can transform speculative assets into institutional infrastructure, supported by fundamental liquidity conditions. However, sentiment indicators suggest caution as the cryptocurrency approaches potentially overheated levels. Perhaps most importantly, June's inflation and retail data highlight the challenge of distinguishing between nominal growth driven by price increases and real demand expansion. The upcoming PCE data will be crucial for understanding whether consumer strength is genuine or merely reflecting higher prices for similar consumption levels. The overall picture suggests an economy that remains fundamentally resilient, with corporate strength offsetting consumer caution and credit metrics remaining stable. However, the evolution of tariff impacts, interest rate policy, and real consumption trends will be critical factors to monitor as we progress through the second half of 2025. That concludes this week's Markets in Minutes. Macro-microeconomic and financial commentary. Want more insights like these? Join our MMAX subscription for full access to expert reports and in-depth market analysis that goes beyond the headlines. I'm your host from the Macro-Micro Research team. Thank you for listening, and we'll see you next week for another deep dive into the forces shaping global markets and the economy.